Hi, I'm Barbara Friedberg, former portfolio manager and university investments instructor. And I'm here today talking with Victor Haghani. His bio is so long and so nuanced that I'm going to let him give you the elevator pitch. So, Victor, tell us a little bit about yourself, where you started, where you are today, and a little bit about how you got there.
Thanks, Barbara. Well, I'll try to give a real condensed version. I was born in New York, but in high school, I lived in Iran. My dad was Iranian, and then moved to London, where I went to university. From there, I got a job at Salomon Brothers in research in fixed income. And then I left Salomon with some of my colleagues that I worked with, and we set up LTCM. And after that, after LTCM, I stayed around for a little while. There was a successor fund, and then I took a sabbatical starting in about 2001 or so for about 10 years. And then I started Elm Wealth, which is a wealth management business that started off as a solution for my family. And then various of my colleagues and friends started to use our services. And we basically help people to efficiently do low cost, tax efficient investing using low cost ETFs and index funds in a dynamic asset allocation. And that's it. We do a lot of research. My partner and I, we're writing a book right now. And yeah, really pleased to be on the show and lots of good stuff to talk about.
Wonderful. Well, let me give you an idea of what we're going to be covering today. We're going to be talking about investments. We're going to be talking about markets, and we're also going to be talking about Elm at the end of our program. But I have to ask you before we dig in, what's the book about?
Well, the book's title, and it's still pretty far out there. It takes a while to get it all together, but we do have a manuscript written. The title of the book is "The Missing Billionaires: A Guide to Better Financial Decisions," and it really starts off asking the question of, what happened to the Vanderbilt fortune? That in like 1880 they had $200 million of wealth, and in less than 100 years later, or more like 50 years later, there was hardly a millionaire Vanderbilt left from that incredibly large family fortune. And did they make bad investments? Did they spend too much? What exactly happened? Well, we don't know exactly in the case of the Vanderbilts, but we know that investors and families face a lot of headwinds when it comes to making good financial decisions. And clearly, their fortune started at the beginning of an amazing period for investing. I mean, $1 back then invested in the S&P 500 is like $100,000 today, and far outpacing a reasonable amount of procreation and spending and gifting and all of that. And so the book really tries to go into what are the kinds of mistakes that people have made and what are the sound things that we can do. And really, it comes down to the risk-taking decision that it's not so much about finding the right investments. It's about not taking too much risk or too little risk. And we talk about how to think about that. And it's about spending policies that also make sense. You can't kind of set an amount of spending and then not revise it if the value of your investments has gone down. I mean, the 4% rule in its simplest form, where you retire, calculate 4% of your wealth, and then spend that amount every year adjusted for inflation. That's not a good long-term rule, because your spending has to move with your portfolio, or you have to make your portfolio not move at all. You have to annuitize the whole thing. But if you want to take some risk in the hope of getting a higher return and being able to spend more in retirement, then you also have to be willing to move your spending around. And also the spending rate can just be too high. Like if you're making if you've gone through some years where you've made 8% a year on your money, you can't say, okay, I'm just going to spend 8% of my portfolio, because that was a risky return, and you need to risk adjust that and haircut it some more. So spending rates, long-term spending rates need to be lower than many people initially think. You can't spend if you spend the expected return on your portfolio, that's going to have your portfolio going down pretty dramatically over time because of a convexity effect. So that's there's more in the book than that, but it's kind of, those are the main things.
Well, you've piqued my interest. It sounds like there's going to be something in it for everyone. And I do want to tell our viewers that if they want to learn more about this, where are the billionaires, and can't wait for the book to come out, I'm going to put a link below to Victor's TED Talk where he delves into that issue. And it's really something fascinating to think about today. Now, something else you said kind of got me thinking. Everybody talks about the stock market and crypto and crowdfunding and real estate, and bonds are like ho hum. Well, since you got your start in bonds, and since we are currently in a rising interest rate environment when bond values tend to go down, tell us how are you thinking, and how might investors think about the fixed income portion of their portfolio today?
Sure. So, I think the first thing that a person needs to do in trying to get their financial house in order is they need to think about, what's their objective, what's their what are they measuring their financial well-being in terms of. And I think the most natural thing is to think about what real or inflation-adjusted income stream your wealth and also your human capital can generate for the rest of your life. Like that should be that's a good starting point, I think, and that's really different than being focused on what's the lump sum present value of your wealth. Now, it turns out that we go back, I don't know, 100, 150 years ago or more, that whenever you're reading a book from those days, it never talks about somebody's wealth as so and so had a net worth of 5 million pounds or whatever. It always talks about people's wealth in terms of an income stream, that so and so person, Mr. Darcy or whoever, or King George III, gave an income stream to the Duke of Wellington of, whatever, 10,000 pounds a year for the rest of his life and the life of his eldest son. So, that's the natural way, I think, to think about wealth, is what sort of income stream can my wealth generate? And so now when we think about fixed income, we have three kinds of instrument. We have things like treasury bills and floating rate notes and short-term treasuries that don't move around in price very much, and they just give us the short-term interest rate. Then we have long-term nominal bonds that have a fixed coupon, and they give us a fixed rate of interest if held to maturity, but their prices move around a lot. And then we have inflation-linked bonds and also ICE savings bonds, which is really a very limited size in terms of how much you can buy of those. But we have inflation-linked bonds that have been around now for just over 20 years, called TIPS. And those do give us this inflation-adjusted income stream. The inflation it uses is CPI, and that may not be exactly the right index for all of our consumption. Different people consume different baskets of goods, and CPI is one particular basket, but it's a decent sort of proxy. Maybe for affluent people, it kind of underestimates a little bit the inflation that people experience and the luxury type goods that they buy. But it's a decent starting point. And so when we think about fixed income, we kind of think about these long-term TIPS as being the safest asset and the starting point for thinking about the risk of all other assets that we can buy. So we start off with TIPS, and we want to then sort of think about the expected return of all different potential investments relative to that. So we get this strange kind of result that treasury bills are fairly risky. And they are measured in those terms, right? I mean, well, since if you had 100% of your money in treasury bills over the last 20 odd years, you've lost more than 20% of, or roughly 20% in terms of purchasing power, but also in terms of that long-term annuity stream that they could generate, that your wealth could generate. That's also gone down by 30%, because real interest rates, TIPS rates, went from 4% around the turn of the century to now they've gone back up again, but 30-year TIPS are yielding about 0.5%. And so, if what we're focused on is the long-term income stream equivalent of our wealth, treasury bills are risky. Long-term nominal bonds are risky when inflation is moving around. If inflation is fixed, then they're the same as TIPS, but we know that inflation expectations change. And so they're quite risky also in that inflation can really eat at them. So that's kind of how we look at fixed income. I think when we think about corporate bonds, high-grade corporate bonds, or municipal bonds, there's some credit risk in those, and there's also tax considerations. Corporate bonds are taxable at the state level, for instance, whereas treasuries are not. Municipal bonds obviously are not taxable federally, and if they're your state bonds, they're also not taxable. So there's issues like that. But by and large, that's how we think about fixed income. And we just sent a piece out today, in fact, where we make the point that even though stocks are down, inflation is up, interest rates are up, and the value of our portfolios for most of us are down since the beginning of the year, that if we were focused on the long-term real income stream that our wealth could generate, that's not down so much. At least we did the calculation to the end of April. That's not down so much. So, like our portfolios might be down 10 to 15% in inflation adjusted terms. I mean, they're down close to 10%, 10% or more just nominally. And then we've had about 4% inflation since the beginning of the year. But the higher long-term real interest rates that are available now counteract that and leave us roughly in the same position as we were 4 months ago. So I think that's, I think it's helpful to think about investing in those terms, starting off by really thinking about what's your safe asset, or what would your safe asset look like exactly.
Now I'm going to push you a little bit on this topic, because from how you discussed it, and given the past 20 years, I've been investing for close to 40. So up until the 2000s, we had very, very nice yields and returns on bonds, and you could actually get cash flow in many cases beating the rate of inflation. That hasn't been the case since 2000. And like you said, a complete bond portfolio would have lost money. But you missed one point, which I'm going to frame in a question. Are you saying no bonds, or bonds are a horrible investment, or what do investors do to offset the risk of an all stock portfolio?
Oh, yeah. Well, so I guess I didn't spend a lot of time on that, but we start off with what's my safe asset? And let's say that I think it's something like long-term tips. Then I look at all these other assets that are out there, treasury bills, long-term bonds, but let's put those to the side for the moment, because I don't think there's a lot of extra, probably not a lot of extra expected return in owning treasury bills instead of tips, or 30-year nominal bonds instead of tips. I mean, there's not a lot of juice in that. So let's just keep focused on tips. And now we say, okay, now let's look at equities, because equities is the big thing that we should be considering as the accessible risk asset that is the alternative to the safe asset. So we look at equities, we look at U.S. equities and non-U.S. equities, and what we see is that equities are offering a pretty healthy extra real return relative to tips. And now we just have to decide, well, I'm going to get extra return. There's also extra risk involved. And what's the right amount of equities that I want to own, based upon their risk and return relative to my safe asset of bonds. And whatever I don't invest in equities, I'll have in bonds. So for instance, for me and my family, right now, the long-term expected return of equities relative to safe interest rates, safe real interest rates is pretty good. It's maybe around 5% globally, US plus non-US. So that's pretty nice. But we're in a pretty risky period right now. So from a risk point of view, I want to have less than otherwise. And when I put those together, I wind up at about 60% in equities, 40% in bonds. So that's where I am personally. But every person will be a little bit different in terms of that. And maybe somebody, if somebody doesn't want to change their allocation over time, I think that for a lot of people, going for, something like a, 60, 40, 70, 30 type of arrangement of equities versus bonds is sensible. And where the bond portion is heavily weighted towards tips. And actually, I was just reminded recently that David Swensen, the late and great David Swensen, recommended for individuals to keep half of their fixed income allocation in tips.
Wow, that's a lot, right?
I know, because tips is such a small segment of the whole fixed income market. But
well, and you think about the last few years when the returns on tips have been negative. So interesting. Yeah. So that's so not all in fixed income, not all in equities, sort of down to your view of return risk and your level of risk aversion as well. But I think that taking that long-term horizon of real income stream, when you do that, it just changes everything in terms of your perception of risk, because now treasury bills are risky, long-term tips are a lot less risky, and equities are also somewhat less risky because part of their movement has to do with the discount rate part of it has to do with earnings streams as well, but part of it is also coming from changes in the discount rate, which on a long-term basis are something that we don't, isn't changing that long-term real income stream equivalent of our wealth, right? So if we own equities, let me just say that slightly different way. So let's say that, so first of all, say that you got 100% of your money in tips, right? And let's say the tips yield is 1% and you expect to live 30 years. And so you can just say, okay, well, I can spend, if you knew exactly how long you were going to live, you could say, well, I can just annuitize my wealth using this 1% discount rate
over the next 30 years. And that tells me how much real income I'll have every year for the next 30 years, let's say. And now the tips rate goes from 1% to 2%, right? And the value of those bonds that I hold, maybe it's gone down by 15 or 20%. So I look at my brokerage statement and I thought I had $5 million in there. Now I have $4 million in there because I lost 20%. And it's like, oh no. But if I look at the annuity stream equivalent of my wealth, this $4 million can generate exactly the same amount of income in inflation adjusted terms every year for the next 30 years. So I'm no better or worse off. And that's why that's a safe asset for me. Now let's take an example of equities. And let's say I was 100% in equities. And now let's say that that equities go down 20%. And but what I think has really happened is that the market is discounting future earnings by a higher discount rate. So I still think that the real earnings stream looks about the same as it did before equities went down. Well, then again, my real long-term income stream is going to be about the same. And even though the value of my portfolio is 20% lower, my real income stream is the same. Now, I'm not saying that's when equities go down 20%, they can go down by 20% for one or two reasons, or a combination of those reasons. One of them is the discount rate is higher. People are requiring a higher return on for owning equities. That's one thing. Or the second thing is that the expected earnings power of those equities in real terms is lower. Maybe there's been bankruptcies, or there's an unexpected large recession or depression, or much higher tax rates than people had been expecting. All these different things, and so that earnings stream is lower. Well, when that happens, that's bad for me. Now I'm going to have a lower long-term real income stream from my portfolio. But if most of that drop in equities came from a higher discount rate, then I'm no worse off than I was before. Even though when I look at my brokerage account, I sort of have a little moment of being upset. So that's elaborating.
Well, and isn't there a little psychology involved in this too? Because investors can get scared by a variety of different factors, and when that happens, they require greater returns from the risky asset, the equity markets.
Yeah, I mean, I think most observers do believe that the required return, or the discount rate on equities, changes a lot over time for exactly the reasons you've said. I mean, it makes sense that the real interest rate moves around. It also makes sense that the real discount rate on equities moves around too. But there are those two things going on. But I was just saying, if it was more one than the other, then it's not that bad. But I tell you, I've been thinking about my partner James and I, we've been thinking about things like this for a long time. But you have a spreadsheet or whatever, and you log into your brokerage account and you get those numbers and you think, oh my God, this is terrible. Or they go up and up and up, and it's like, this is great, but they've gone up because the real interest rate went from 4% 20 years ago to 0 today or whatever. It's like, thank goodness everything went up, because I need to have more money in order to generate that income stream. So even though like my family's investments have done quite well over the last 20 years, when I stop to think about it, I'm not really much better off, because that long-term expected return that I can earn is much lower than it was 20 years ago. And that's really difficult, I think, for anybody to accept, because it's just so ubiquitous that we're looking at the present value of our wealth, the lump sum present value. And as I say, that's a phenomenon that comes about from having all these public markets that people are invested in. Again, go back 200 years, nobody really owned stocks. They owned land or this or that, and they were thinking in income streams. So, boy, I think
that's a really important thing to think about, especially as you age, is the income stream that you can get from your portfolio, and figuring out how you can do that, how you can get that. So
yeah. And unfortunately, one last little point, unfortunately, the insurance companies have stopped, and never really were, but have stopped issuing real annuities. So, if you want to try to reduce your longevity risk aspect of your wealth, you have to do that with these fixed annuities, and so wind up taking inflation risk, which is unfortunate, because they could. I think that it's not, the tips market exists for them to invest in. They could do the annuities and do it in real terms instead of in just nominal terms. But, for a lot of people, I think longevity risk is a bigger risk than inflation risk, for instance. So, annuities are another part of that fixed income bucket, even though they kind of have a bad name because of all of the complex, expensive ones that are out there. My mom told me that she had an annuity, and when I looked at it, we decided together that it was ridiculous and she should get out of it. But an annuity also makes a lot of sense for her. Just a plain vanilla, low cost one that's simple and easy and all of that, would have been, probably okay for her. Although the way she approaches things, I think she's, her spending is low enough relative to her wealth that she didn't really need an annuity anyway. But it's kind of, I'm in favor of simple, low cost annuities, but like many other financial observers, that these really complicated ones that are impossible to value and have all kinds of difficult features aren't so great.
So Wade Pfau has a fabulous book on annuities. Really talks about the ins and outs and the types that would be best for individuals and couples, but you do have to watch out for fees. And there are low-cost annuity providers. So definitely that's a really nice addition to your Social Security income stream. But I want to shift gears a little, Victor. We are sitting here in beginnings of May 2022, after a crazy 2021 of the S&P gaining like 26%, we have now moved into more rocky territories. Tell me what you're thinking about the markets. What are your ideas about what's going on? And what should the average person do in a situation like this?
Well, I think if you have, starting with the last question, if you have a sound plan and approach for what to do, stick to it. I think that's, we're not in some completely uncharted territory that would require people to revise sound financial plans that they would have. So, if you are somebody that's like, well, I just want to be 65% in equities, 35% in bonds, and so on, then, stick to that and rebalance back to that, when you would normally do so and go forward like that. If your approach to investing was sort of trying to ride the wave of new and future technological innovation, in the U.S. You were very heavily invested in that. You might want to, even though it's a painful time to do it, you might want to reconsider whether that is a sensible long-term financial approach for you. But if it is, then again, you should stick to it. If that is really, I think that one of the worst things that we can do as investors is be return chasers. So when things are going well, just continuing to pile in and add and add and add. And when things are going poorly, to sort of decrease, in a sector or in the overall market, whatever it is. And that's why the fact that people do tend to do that is why we see investor returns much lower than fund returns when looking at mutual funds. That when you look at $1 invested in a mutual fund to some date, that IRR or return tends to be substantially higher than the IRR of the cash flows of investor money coming in and out. So, really one of the most powerful examples of this that I've seen is like Cathie Wood's ARK, where I think today, let's say the ARK ETF is around 50 or so. I think that's like a 3 or 4x since she started the fund back in 2014, I believe. And so, if you invested in the beginning, that's great. You've made 3 or 4 times your money. That's still a good return. I mean, even though, it's down a lot from its high point, I think it's down maybe 2/3 or so since the highest point that it reached sometime last year. But that's still a really good return, right? But if you actually look at, you can see the investor inflows and outflows from ARK. And when you look at that, because you can see how many shares of the ETF are outstanding on every day. And when you look at that, you actually find that investors in aggregate who have invested in ARK are down several $billion. They're down, or if you look at all the money that's gone in, if you look at the total value lost versus all the money that's gone in, it's a very substantial percentage loss on average for everybody, because ARK went up and Cathie Wood got really famous and people got to listen to her, and she's very charismatic and says a lot of sensible things, I guess. And so people, piled into this when the price was really high, and now the price is not so high. And I think that's really the number one enemy that I think we have to guard against is sort of blowing in the wind too much. It's like, let's have it's always good to to think about whether your plan makes sense. But if your plan makes sense, then stick to it. And, you don't need to do some evasive actions or whatever. I think that, markets and economies and everything are relatively healthy and at some level. I mean, sure, there's speculative frenzies, here and there, or maybe in big, I mean, not, when I say here and there, it's here and there when you look at it on a global scale. These areas of sort of high expectations, et cetera, are still a relatively small fraction of the total global marketplace. So yeah, I don't know. I hope that's responsive.
No, that was exactly the appropriate response. In other words, stay the course. When you get into investing in equity markets, hopefully someone told you, particularly younger investors who have only seen an up market up until January 2022. Hopefully someone told you that markets can go down too.
Yep.
And so that you're not surprised by that, and that you
Yep.
understand that's a normal part of both businesses and investment markets. They go up and they go down. But if you look at history over long term, and you look at both US and global markets, and I think Victor and I are very much in accord that the world is a big place and investors should look beyond their home country. But there are going to be periods where investments go down. And you need to have a strategy that you understand and be prepared for that and accept that. If you jump out at the bottom of a market, then you don't know when to get back in. You're going to have a worse return most of the time than if you just waited it out and began
Yep.
with an asset allocation that will carry you through both good and bad times.
Yeah, yeah. And so, yeah, so I think it's fine to have that static asset allocation that we're talking about here, or you could have a dynamic one, but that dynamic one has to be something that really makes sense in terms of getting you out, getting you back in. How are you making those dynamic decisions? And they have to be sensible. So it's okay to change your asset allocation, but it should be done in sort of a disciplined, rules-based way that makes sense in the long term. It can't just be like your rule can't be like, when the market is down 15%, I sell everything. Like, that's not a long-term plan. You need to, that if you might say, okay, that's okay, but then when do you buy? As you said, when do you buy? Because otherwise it's like my investing strategy is I buy, I sell, and then that's it for the rest of my life. That's not a that's not a plan. You need to have a whole plan laid out in terms of what you do, and the more that plan has to do with you watching the TV and making subjective decisions about what to do, like, I'm gonna, my plan is I'm gonna get out when it feels like I should get out, and I'm gonna get back in when it feels like I should get back in. That, for most people, for me, that would be a recipe for disaster. And I think that there's a lot of evidence that for most people, that's kind of a recipe for, not getting the returns that you deserve to get. And, it also kind of creates a pretty, bad sort of mental experience. I mean, that we also, that we don't want our financial life to deplete the rest of our lives of joy and meaning and all of that. And, sort of, reading, spending all of our time watching the TV along with 100 million other people and trying to figure out what to do is less fulfilling than some other things.
I would think so. That would be a very valid point.
You gotta, if you're going to do that, you got to be pretty sure you're going to make a lot of money doing that. Which I think is hard.
Yeah.
Like
I think more fortunes have probably been lost by making decisions based on television than have been gained. Obviously, I have no data to support this, but it's a hunch. So, Victor, I think now is a really good time to transition into Elm. And Elm is a managed portfolio that Victor Haghani and his partner, James White, developed about a decade ago. And I've delved into it a lot. I think it's got some really interesting nuances to it. Not the best of which is that the fees are really, really low, like mind-blowingly low. But I do need to caution you, this is a fund for high net worth investors. So if you're not there yet, I think it's still a good idea to learn about it because it's a really interesting philosophy. And when you do get to the point where you can reach the minimum investment amount, it might be something you want to consider. So, Victor, help us understand a little bit about what brought you here and tell us about Elm, and then tell us the fees, and also, tell us the minimum. We got to know that.
Okay, absolutely. So, by the way, we've made a bunch of like 30-second to 1-minute videos on YouTube that you can go to. I'll give you the link of our YouTube channel. and there's a lot that's explained there. But the very short version of it is that Elm grew out of how I wanted to manage my family's savings, and in particular, I wanted my family's savings to be managed like this for the very long term, so that I didn't want my kids to feel that they needed to do some, spend their time monitoring and figuring out markets and all of that. So part of it was to really think about what's a sensible sort of evergreen approach to investing that would really take a lot of the anxiety and worry out of the whole process. So first of all, it's a lot of diversification, index funds, trying to keep costs really down, trying not to bear risks that are likely not compensated risks, and a lot of transparency, and for taxable investors, a lot of tax efficiency too. So those were sort of the non-negotiables in some sense. And I realized early on that I wasn't going to, that I didn't think it made sense, and also I knew personality-wise that I wouldn't be able to stick forever to some predetermined asset allocation percentages and never change them again. That I felt that the world is changing, expected returns are changing, risk changes, and the makeup of the global marketplace is changing too over long periods of time. And I wanted an investment approach that would be responsive to that, but in a very simple, transparent, rules-based way. And so our investment approach looks at the long-term return of, at the most basic description, there's a little bit more to it, but this covers most of it, is that we look at equities. We look at the long-term expected real return of equities as indicated by the cyclically adjusted earnings yield. We compare that to the long-term tips rate, and that gives us—
I want to just stop you for a second. Will you give us the definition of the cyclically adjusted earnings yield for those of our listeners who don't know what that ratio is?
Sure. So you basically take the average earnings over the last 10 years of an index like the S&P 500. How much earnings did all those companies make on average every year? We adjusted for inflation to bring it to the present time. And so that's like the average earnings of all of these companies over the last 10 years per year. We divide that by what you have to pay to buy those earnings. What's the price of the S&P 500? So you could think of it as, well, if I buy the S&P 500 and if all these companies in it paid out as a dividend all of their earnings every year, which they don't do, but if they did, then that's the yield or the income that I would earn on my investment that year, and going forward. And so this metric of earnings yield, it's believed, that it makes both logical sense, and it's also empirically the case, that it's a reasonable, imperfect, but reasonable indicator of the long-term real return of the equity market. So when the earnings yield of equities is 5%, that means that it's a reasonable guess that held to a very long-term horizon, that I'm going to make a 5% return above inflation from buying those equities. And by really long term, I don't mean 2 or 3 years, I'm talking about, 20 or 30 years or more, which is, sounds like a really long time, but that's what's relevant to lifetime financial decision making. I mean, when you're in your 30s, you're thinking about 60 years or more. And even when you're in your 70s, you still can have a very long-term horizon, especially if you're planning on doing some intergenerational gifting as well. So that earnings yield minus the tips yield is giving us how much extra return in the long term do we expect to make from holding equities? And that's one of the inputs. So the higher that is, the more equities we want. The lower it is, the less equities we want. And then we use a risk metric. So when the market is riskier and crazier and all that, we reduce our exposure, and vice versa when it's kind of quieter and so on. And what we use, there's a lot of things we could use for this sort of risk indicator. We like to use a momentum indicator for that. So when the market is drifting up, that tends to be a lower risk kind of environment, and we would have more equities in that case. And then when momentum is negative, we reduce exposures, and we increase them again when momentum goes positive. So on average, that momentum signal is 0, because sometimes you're drifting up, sometimes down, more or less. And so that's what we use on the risk side. So that's how we're doing the asset allocation. We start off with a balanced baseline of about 75% equities, 25% fixed income. And then, we move it up and down. So right now in our balanced portfolios, we're at about 60% in equities, or maybe just under 60% in equities. In the middle of 2021, we were over 90% in equities, and we had been that way since the middle of 2020. So it moves around as these metrics move around, but it kind of satisfies this need that I think that I had, and I think a lot of our investors have, to feel that they're being responsive to changing market conditions and not being static completely. even though we use index funds to sort of get away from stock picking and get the high diversification and low fees, built into the portfolio. We charge 12 basis points. That's our fee, the only fee that we charge. We manage portfolios. You can have an account at Fidelity or Schwab. They don't charge any commissions on the trades. And Schwab has no account fees at all. Fidelity has about $150 a year account fee, or is it $170? And that's it. So you pay 12 basis points to us, and then whatever is the fees that are in the ETFs, which average less than 10 basis points. We do tax loss harvesting in taxable accounts. So we're doing a lot of that this year for investors. Right. We're capturing some losses for them. We try to capture short-term losses when possible, in particular. And we also do custom programs for clients that want to give us more of their savings in larger amounts. So we have a $500,000 minimum for a family to work with us. And for custom accounts, depending on what it is they want to do, it's $5 to $10 million. And we also manage money for non-US investors. We have a few solutions for them. And we've been doing it for 10 years. We have about $1.5 billion of client assets from about 300 or more families. And a lot of our investors are finance professionals, because they're people that I know or James has known or know those people, that are then referred. So there's a lot of finance folks that are in it, but a lot of other professions and walks of life are there too. And we have some young people. Sometimes we waive our minimum, in some cases, especially for young people, because we want to get them going and try to be helpful to them. And that's it. We do a lot of research and a lot of writing, and we like to spend time talking with our clients and giving them some guidance. But with our 12 basis points, we're not we're not a concierge kind of wealth manager either. So our clients understand that, and it's a pretty happy arrangement altogether. Looking forward to the next 10 years of doing this.
Now, how do you benchmark your returns? So what type of benchmarks do you use to compare your portfolio returns?
Sure. So the main one that we give to people in our investor reports is, how has this dynamic asset allocation performed relative to if you had just had a fixed static asset allocation? And we break that down also between how much have you been helped by the long-term excess expected return dynamic part, and how much by the risk part. Like, is it, have we helped you more by reducing risk when reducing exposure when risk jumped up like it is right now, or have we done better by sort of buying more equities when the excess return has been higher? So we show investors those numbers. We have a tool on our website that has all historical returns on it, model returns, because we're doing separately managed accounts. So everybody's account is a little different, but we have model returns that people can look at going back not only to our inception, but even looking at how this approach to investing would have done for years prior to when we got started. So you can see how they did over the financial crisis of 07, 09 as well. And so, we benchmark against a static portfolio. Sometimes people look at us versus other things, but, I think that it's not, that if somebody says, well, I want to benchmark you against the S&P 500, well, that's not an appropriate benchmark, because we're starting with the balanced portfolio. We're not 100% in equities. And we also believe in global diversification. That's a really valuable thing. And in some ways, the US outperformance over these years shows you how important that diversification is, because it's also conceivable it could have been the other way around, that foreign markets did what the US has done in relative terms. So
like in the 90s.
Yeah. I mean, these things tend to go on for a long time, but they also can reverse for a long time too.
So where can people find out more about you and about Elm?
Elmwealth.com is the gateway to all of our stuff. You could also look for Victor Haghani, and that will take you to Elm Wealth. They said we also have this YouTube channel where you can find these short videos. One of them gives you the Elm story. Another one is sort of an introduction to how we invest and who our investors are and things like that. So I think that's a really easy way to get acquainted with what we do as well.
Well, this has been so much fun talking with you again, Victor. I always love hearing your insights. And for those of you watching this video, we have links below to Elm, to Victor's TED Talk, to his YouTube channel, and other related information that we think you will enjoy. If you like this video, please give us a thumbs up and subscribe. you will help us to create more content for you. So thank you so much, Victor, and really appreciate you coming on.
Thank you, Barbara. My pleasure.